4-year high inflation, rising interest rates, increased pressure on banks, more loan demand. The banking system in the USA is stretched. Many factors are slowly but surely weighing it down in every state, putting more and more strain. The upcoming recession could lead to a banking crisis and total collapse of the entire banking system. If that happens, you will not be happy to find yourself in an unprepared state. After watching this video, you'll know whether you should start packing your things. To understand why the history of 2008 might repeat itself, we must first find out how the banks failed. In 2008, it was all about the housing mortgages. Banks have issued millions of loans to home buyers and repackaged them into securities called CDOs or collective debt obligations. The main idea was shifting the risk from the banks that gave loans, but the system worked the wrong way around, and the same banks who gave the loans were heavily counting on the CDOs. As the crisis hit, the banks have started disclosing billions of dollars worth of losses. Some giants even went under, like Lehman Brothers. The federal government did find a way to save banks and lower the panic. Later in 2010, the Congress forced banks to start borrowing less, make fewer long-short bets, and show more transparency about their holdings. But those changes didn't help at all. Banks are greedy, and they won't miss the opportunity to earn money, so big players have quickly forgotten the CDOs and moved to CLOs, collateral loan obligations. CLO is almost the same as the CDO, but not for home buyers. CLOs are all about businesses. Small ones, big ones, medium ones, all of them. The two securities are remarkably alike, like CDO. A CLO has multiple layers, which are sold separately. The bottom layer is the riskiest, the top the safest. If just a few of the loans in a CLO default, the bottom layer will suffer a loss and the other layer will remain safe. If the default increases, the bottom layer will lose even more and the pain will start to work its way up the layers. The top layer, however, remains protected. It loses money only after the lower layer has been wiped out. Experts are currently estimating the CLO market to be bigger than the CDO market was before the crisis. The Bank of International Settlements assured the market size was roughly $750 billion. The CLOs weren't an imminent problem before 2020, but COVID destroyed thousands, if not hundreds of thousands of businesses all over the country. Even after 2 years, many business enterprises are going under, unable to pay their loans. The inability erodes the foundation the CLOs are built upon. It's only a matter of time when the point of no return will be reached. History is about to repeat itself, but instead of busting the CDO bubble, we're about to see the rapture of CLOs. Famous Dr. Doom in July has pointed out that there are thousands of zombie corporations that have used all the loan they've got after the pandemic to build businesses that can be profitable or scalable. The percentage of such businesses varies from one state to another, and so does the strain on the banking system. Most of US states have enough reserves and a well-ruled banking system to survive what's coming. Moody Analytics say that 43 states out of 50 will survive the recession and a crisis at varying degrees of success. Other states are vulnerable, don't have enough savings, high taxes, and low GDPs. So, let's look at the 5 worst states to live and bank during the banking downfall. The 5th place in this rating is occupied by Idaho. This state has a very high debt-to-income ratio and offers a miserably low unemployment insurance coverage of only 16.2%. Add to it a high income tax of 6.8% and you'll get one of the worst states to be in during the banking crisis and recession. Maine's are also in danger of not surviving this upcoming crisis. The state of Maine has a high income tax of 7.2% and low salaries. Add to it low affordability of budget-friendly accommodation and you'll get a recipe for a disaster. In the past, the state wasn't enduring the recessions well. Even 2 years after 2008 recession, the state's economy was still 2.3% down in comparison to pre-recession levels. Arkansas proudly occupies 49th place in the state rating by GDP per capita. At the same time, its government reserves are sitting at 48th place at only 3.7%. During the last recession, the state's economy sank 4% and currently only 20.9% of households can actually afford averagely priced homes. Arkansas has never been great great at keeping its fiscal reserves in order. The state government started building the state reserve in 2016 while capping the incoming funds at only 3%. It is not difficult to estimate how much money is in that reserve, especially after the COVID. Arkansas has a very high chance to ask other states for financial aid during the upcoming crisis and crash of banking system. Florida, on the other hand, was allocated 8% into the reserve. However, the economy of Florida is much more vulnerable since it's mostly relies on tourism. And during a crisis, tourism is not happening. The unemployment insurance in Florida is minuscule, only 11.5% of people get it. And the income to debt ratio is 0.91. Mississippi is by far the worst state to be in. High unemployment rate, low government reserves, low unemployment insurance coverage, plus it has the absolute lowest GDP per capita for all the USA, only $42.802. Mississippi bankruptcy case filings are up 16.2% for the first 9 months of 2022 as compared to 2021. You definitely should consider relocating from Mississippi because that ship will sink fast. Currently, the banking system is relatively stable. It is in danger, but banks are still capable of paying off their debts and passing tests. But crashes do not happen in one night. It took almost a year in 2007-2008 for banks to fully collapse. The US is nearing the recession. The interest rates are peaking. America is consuming more than it produces. The stock market is through the roof, and the housing market is at an all-time high. The Fed will continue to increase interest rates. People will borrow less, and banks will give less. And that can be a death sentence to a market that's entirely built on a debt. To you, it means one thing: it is time to think about relocating. What do you think? Are these reasons to be worried? How are you preparing for the upcoming turmoil? Write your thoughts in the comments and like this video if it was useful. Also, subscribe to the channel to always be informed about the news in the world of finance. Good luck and see you in the next one.